Hi, I'm Kara Murphy, and this is Money with Murphy. As followers of our work may know, my pre-Wall Street background as a political analyst comes in handy on occasion, helping to inform investment decisions. Last week, we put that background to work and discussed investing during a presidential election. This week, we're focusing on political risk outside the U.S. Recent conflagrations include the Russian invasion of Ukraine, now stretching into its third year. More recently, we've seen conflict in Israel and Gaza, and now Iran, an important player in the Middle East, has lost one of its key leaders. Meanwhile, in the background, though no less important, U.S. relations with China remain strained. Given these factors and others, the Eurasia Group, a political risk consultancy, cheekily called 2024 the Voldemort of years, the year that must not be named. Another more staid measure of geopolitical risk by the BlackRock Investment Institute shows global risks rising, though still well below previous periods. In the U.S., we have the fortune of being geographically removed from the rest of the world, sharing a border with just two countries. Because of that geographic isolation, risks elsewhere tend to become muted by the time they reach our shores. These types of risks often affect U.S. markets in two ways, through higher general market volatility and higher oil prices, neither of which is providing a warning sign. The CBOE Volatility Index, or VIX, for instance, is currently at one of its lowest levels in 35 years. Brent crude oil is 10% below its recent peak. This suggests that investors are not expecting conflict in Europe or the Middle East to grow wider. Over my many years of talking about markets, an ever-present risk to any rosy outlook has been geopolitical events. The downfall of the Soviet Union created the possibility that nuclear weapons would get into the wrong hands. The attacks of 9/11 prompted an expectation of further attacks on American soil. Other times, risks materialize but don't have the expected dire consequences. When the UK voted to leave the European Union, markets in Europe and the US tumbled and then quickly recovered. After Russia invaded Ukraine, oil prices rallied, then fell. These threats were all very real, and in some cases are still possible, but up to now they've been averted or largely managed. As such, building a portfolio around these possibilities would have been wrong because in each case, markets managed to rally in the years that followed. The risks we currently face, an emboldened and nationalistic Russia, instability in the Middle East, and a contentious relationship with China are also very real. And those risks should not be the primary driver of your investment decisions. An effective way to manage through highly disruptive, yet highly unpredictable risks is a tried and true approach. Own a diversified portfolio with exposure to different sectors and different geographies. And until next time, invest wisely and live richly.